Hello and welcome to Outlook Money's Investment Made Easy podcast series. This episode is led by ICICI Prudential Asset Management Limited under the Investment Awareness Initiative of ICICI Prudential Mutual Fund. I'm Versha Jain from Outlook Money and your host for this session. Welcome to another episode in the series where we break down the complexities of the financial world and give you insights that could potentially enhance your financial understanding and well being. Today's episode is brought to you in association with ICICI Prudential Asset Management Company Limited, and our topic for discussion is Smart Beta ETFs. While investment in equity comes with risks, passive investing in them is considered a less risky option. And in that category, passive exchange traded funds offer fast liquidity than the mutual funds. In ETFs, there is another category, Smart Beta ETFs, that combines the features of both active and passive fund management. Our today's discussion is around these ETFs, where we will learn more about the Smart Beta ETFs, how they work, for whom they are useful, and their utility in the portfolio. To delve deeper into understanding the Smart Beta ETFs and answer these questions, today we have with us Mr. Chintan Haria, Head of Product Development and Strategy at ICICI Prudential AMC, who will share insights on the Smart Beta ETFs and its utility for investors. Without further ado, let's begin the session. Welcome, Mr. Haria, to this episode.
Thank you, and always a pleasure to connect with all the listeners of Outlook. Thank you.
Okay, so to start off, Mr. Haria, please explain to our listeners what is a Smart Beta ETF?
So while I'm sure listeners have heard our earlier podcast, let me start for the benefit of those who are probably listening for the first time about ETFs. Let me start with the basic. I'll keep it short and simple and then move to Smart Beta ETFs. So a lot of investors today are investing through mutual funds and probably are getting confused as to what is open-ended, close-ended, what is an ETF, what is an index fund. Just to put it simply, when you're investing in a mutual fund, it is essentially a set of stocks which can be actively managed where the fund manager is involved. So these are called active mutual funds. And there are a set of passive mutual funds, which could be either an index fund or an ETF. I'll explain what an index fund or an ETF is. But these are passive funds where the active fund manager is not involved. And as the name suggests, the passive funds essentially replicate a set of stocks which are forming part of an index where the methodology is already known to the investor before the investor is investing in that particular index. So essentially, passive funds are simply endeavoring to replicate the underlying benchmark index, which is already created through a set of rules or a methodology. Now, within passive funds, we have index funds and ETFs. Index funds essentially work similar to the traditional mutual funds wherein you'll invest. You can do SIPs easily and you'll get the day and NAV. The index funds endeavor to replicate the underlying benchmark. ETFs, which is exchange traded funds, are also mutual funds, but the one thing which differentiates ETFs with active mutual funds and passive index funds is the fact that ETFs are traded on the exchange, much like how you have stocks traded on the exchange. So it is the convenience that on a live market basis, when markets are open, the prices of the ETFs go up and down in tune with the underlying stocks in which the ETF invests. So ETFs are also passive funds which are investing in underlying index, which is a set of stocks based on certain methodology. Now within ETFs, the first thing is that there are equity ETFs, debt ETFs, commodity ETFs. For the purpose of simplicity, let's stick to the equity ETFs itself, which is the core of the discussion today, since the topic, which is Smart Beta ETFs, is relevant from the perspective of underlying equity ETFs. So equity ETFs, essentially, as the name suggests, are investing in equities, where the selection of equities could be, for example, say large cap ETF. So top 50 names in the market, top 30 names in the market. That's how the market cap based ETFs are there. Then there are sectoral or thematic ETFs like infrastructure, FMCG, auto, where you're getting basically a certain set of stocks based on a certain sector or theme. Now, I spoke of active funds, and I spoke of passive funds, which is where one side the fund manager is involved. As you all would know, the fund manager takes decisions on selection of portfolio on the basis of certain inherent rules that the fund manager follows, be it buying valuation-based stocks or sectoral allocations in a certain manner. And in passives, you're basically replicating the index. So between this active and passive is where the smart beta ETF concept comes into play. As the name suggests, smart beta ETFs are essentially ETFs, which I've explained earlier what are equity ETFs. In the smart beta concept, you have the selection of stocks and the weightage of stocks in a manner which is slightly different from the market cap based or sector thematic based. So smart beta is essentially selection of stocks on the basis of something different. Now, what is this different? The difference can be, for example, I select stocks on the basis of those stocks which are most stable, as it is known as low volatility. So those stocks which are low volatile, which basically are more stable, I select those stocks, I create their weightages on those portfolio. That is low volatility smart beta. Then there can be something where momentum is something which all of you would have heard, where the stocks which have done well in the last 6 months and 1 year, we pick them up and create a portfolio out of it based on the methodology. It is called as smart beta ETF based on the concept of momentum. So you have many factors on which the smart beta concept are. And if you look at the prominent concepts in India in smart beta, it is essentially low volatility, alpha plus low volatility, momentum, quality, and value. These are the ones which are called as smart beta, as the name suggests. The selection is on the basis of one of these factors. And as we move along, of course, we can discuss in detail. But the concept of smart beta is essentially selection and weightage of the portfolio creation for the purpose of ETF on the basis of certain factors which are very common in terms of what an active fund manager would do in terms of quality, low volatility, momentum, valuation, which is value based. And I think we'll probably move on from where we have started in terms of the introduction of what smart beta ETFs are. Thank you.
Thank you so much for explaining it in all simple words and so many concepts and give clarity towards all these things. Now, as you said that there are so many factors to select the stocks from the index, and ETFs are essentially passive investing. So how do we understand a smart beta? It's a passive or active? Because a smart beta ETF is always included in the name. So is it necessarily active or passive or somewhere in between?
So in India, passive funds essentially are, or rather index funds and ETFs essentially are passive funds. That's how the rules are. And smart beta ETFs, being a subset of equity ETFs, are also passive funds where the methodology is already known, where the universe is already known. That is, say, for example, top 100 stocks is the total universe, or top 150 names is the total universe. And out of these 100 names or 150 names, depending on what the universe is, the selection is done basis the smart beta factor which is applied. So smart beta, as the name suggests, is selection of securities on the basis of a factor, and the factor name is normally part of the smart beta ETF name itself. So investors can easily figure out what is essentially the factor on which the smart beta ETF is focusing on. And then in terms of it being a passive fund, investors would at all points of time get exposure to that particular factor, and it normally rebalances on a 3-month or 6-month basis. So in some sense, you're getting that factor in the smart beta ETF, which allows you that clarity that if I want to go for momentum, I go for momentum smart beta ETF. If I want to basically now invest in stocks which are stable, which basically are in the long run going to be stable, and which basically allows me to invest in stocks which are providing me low volatility, then I go for the low volatility ETF. So essentially, smart beta concept is a passive ETF concept in India, because the rules today allow passive funds to generally be, or rather allow smart beta ETFs and index funds to be on passive methodologies, which are already known, and investors can actually see them on the websites. Thank you.
Okay. And in continuation, please also tell us that in general, passive funds replicate the index, and their aim is to copy the performance of the index. Is it the same with the smart beta ETFs also, or because we select some factors, the objective of a smart beta is to perform better than the index?
So the objective of any passive fund, as you have rightly said, is to create the portfolio in a manner which endeavors to replicate the underlying index. Now, the underlying index is already created on the basis of a methodology which is pre-established and published. And based on the methodology, whatever stocks form part of the index, the smart beta ETF manager or the manufacturer will try to replicate those particular underlying stocks in the same weight and in the same proportion as that of the index. So there is essentially a replication of the underlying index, which allows investors to participate in the selected choice of smart beta that they are underlying and taking. So it's a very simple concept. While there can be a lot of complication which can be in the mind of an investor, the simple concept is that based on a known universe, based on a known factor, the portfolio is selected and the benchmark is already there. It is by third-party index providers. Generally, NSE and BSE are the two index providers, which is common. And if you look at the indexes which are available for public viewing and methodologies which are available for public viewing, it will be clear that smart beta is also a passive concept where the selection and the weightage is already based on a methodology, and investors can take full benefit of this clarity while they are investing. And each factor will appeal to a different set of investors at different points of time. So clearly, investors need to understand their risk appetite, try to understand their overall portfolio. And to that extent, it is always advisable that you have a person who understands these things better to advise you or to communicate to you what fits and suits well in your portfolio. But we are seeing increasing interest among smart beta ETFs and smart beta concept among investors.
As you said that the benchmark index is not copied as in the smart beta ETFs. How? I mean, what comes first? First, you select the factor and then the benchmark as provided by the third parties, or a benchmark is selected and then you figure out some factor and then create the ETF.
No, so just to put it again in terms of simple words, indexes can be on the basis of market cap. So you pick up the top 30 names, top 50 names of a market cap, that becomes large cap index. Then you pick up 101 to 250 names and create a portfolio out of it. It becomes a mid cap index. The small cap index is 251 to 500. So those are large cap, mid cap, and small cap indices. In the case of smart beta, the universe is defined in terms of either you have a top 100 names or top 200 names. So once you've defined the universe, the stock selection is on the basis of a predefined factor. We as manufacturers simply replicate the index which is created based on the methodology by the index provider, and the index provider in turn on a 3-month or a 6-month basis keeps rebalancing the portfolio to reflect the factor and the way the factor is basically applied to those top 100 or top 200 names, as the case may be, in terms of the underlying universe. So if you look at, let's say, in terms of the chronology, the factor will be known first. On the basis of the factor, the universe which is already there, say the top 200 names, you apply the factor to the universe and you have, let's say, a 30 stock portfolio or a 50 stock portfolio. So everything is predefined. Either it's a 30 stock out of 100 or a 50 stock out of 200 or whatever the universe is, and the number of stocks are predefined. And based on that, which is 6-monthly rebalanced and quarterly rebalanced in terms of weights, the manufacturer or we as asset managers simply do the job of replicating that benchmark and providing investors an easy, convenient, low-cost way of participating in the factor of their choice in a very transparent manner, where they exactly know what is the underlying universe and what is the underlying universe factor which is being applied. So it's very easy concept. The benchmark and the universe is coming first. It is different from the factor is different from the market cap based indices. That is why they are called smart beta. If it is market cap based, then it is essentially market beta indices. But since the selection of securities in the case of smart beta is different from market cap based selection, it is called as smart beta ETFs. Thank you.
All right, very nicely explained. Um, as you said, there are few prominent factors which people use in India, which is low volatility, value, momentum. So, what do you think? Only one factor is better, or investing in a smart beta which uses more than one factor, which is better?
Think there the answer can be taken from the fact that what is it that the investors currently invested in, and what is the investor looking at, what is the risk appetite of the investor, and what is the kind of risk and reward that the investor is ready to take. Typically, in the chronology of events, in terms of smart beta, low volatility is on the risk curve lower, because the standard deviation of that portfolio will generally be lower, because you're picking up stocks which are low on volatility. So since the volatility is low, the risk adjusted return of low volatility will look higher because it's a risk adjusted return. But if an investor is looking at, let's say, momentum and a potential high return without worrying too much about the near-term risks which momentum strategy may provide, then momentum can give a slightly higher return, but at a higher risk. So it depends on the investor which spectrum they choose. And for those investors who probably want a mix of both, which is low vol and momentum, there is the strategy of alpha low vol, which they can exercise, where there's a two-factor strategy, which basically includes alpha and low vol, which is essentially momentum and low volatility together. So which strategy fits the investor will be dependent on what the investor's risk reward is. But if the investor is very conservative, then low vol works well. If the investor wants to take some more risk and is probably a risk-taking investor, then momentum works well. And if an investor is not sure whether the investor is conservative or very aggressive, then the investor can choose the combination of low vol and momentum, which is essentially alpha low vol. It works well. And those investors who are patient and are ready to wait for long term, for them the value works well. But I would say for most investors, the combination of two factors, which is alpha and low vol, would generally work well over a long period of time in terms of having a smart beta portfolio in their overall portfolio mix. Thank you.
Thanks for clarifying it. And it's an important information that choosing a two-factor smart beta ETFs is better in general for people who do not have the idea about their risk appetite. Now, to the next question, tell us what are the risks involved in the smart beta ETFs? Are they more risky than the passive ETFs, the other ETFs?
Of course, the risk is that if that factor, because factors also have cyclicality, like for example, auto sector was doing well and then it does badly. Say it was doing well between 2013-14 to 2018, then 2018 to 20, auto sector was not doing well. So in the recent past 1 or 2 years, auto sector was doing well. Similarly, pharma has its own cycles, banking has its own cycles. The same way, factors have cycles in terms of when they perform very well and when they perform slightly underperform the broader markets. So from an investor standpoint, I would say it is not about whether the factor-based indices are more risky or less risky compared to the broader markets. It's about understanding that fact that if you consistently are invested for the long run, wealth creation happens in line with the growth of India. The factor which you choose, of course, will decide whether you're taking higher risk, higher return, or whether you're taking lower risk, lower return, because that depends on your personality. But in general, would I say that smart beta ETFs are more riskier than, let's say, market-based index? That would be difficult to predict because there are times where a low volatility ETF will be less risky compared to the market, and there will be a time where momentum is better than the broad market, despite being more riskier in terms of perception. So worry too much about pairing broad market indices with smart beta. Rather, I'd probably say that in the overall portfolio mix, check how the smart beta ETFs fit into your overall portfolio. And then in line with the growth of India, you will find certain factors doing well at certain times, certain factors probably underperforming at times. But in the long run, there is wealth to be created In the short run, yes, there are certain factors which would underperform. So last 2 years, just as an example, last 2 years, the markets have been buoyant. Momentum would have done well. Low volatility as a factor would not probably have done well in terms of absolute returns, but that should not influence the investor's investing style, because the investor decides what is best for the investor in terms of risk and reward. And hence, I said, if you have a combination of alpha and low vol, it will take care of the both aspects of investing, and then the investor may not have to worry too much about either being on one side, which is low vol, or on the other side, which is momentum. You're somewhere in between, which works well for most investors. Thank you.
Okay. And is there any ideal time period also for investing in alpha low vol?
So in terms of any investing that you do in equity assets, ideally it should be as long as possible, but minimum 5 years is what we say. It can be for those investors who don't understand markets that well. Let's say 5 years is a minimum time period that you will need to give to equities. If you understand markets very well, you want to time the market, you want to time the strategies, then you can, but it's a difficult art and you'll need to be well conversant with all the strategies, all the turning points, and probably a little bit more time and effort of yours will go into seeing the market, which may be different from your profession. So if you have the time, fine. Otherwise, if you really want to be an investor with a long-term view more than 5 years, then these things, the investments in equity, be it active, passive, or smart beta, should do the job for you in terms of your wealth creation and participation in the growth journey of India. Thank you.
Okay. Moving on. Please tell us whether these smart beta ETFs are better compared to passive ETFs in terms of expenses and returns. So returns we have already touched upon. Now you may tell us about expenses.
In terms of expenses, just as a general rule in India, passive funds are regulated in terms of expenses, and there is a cap which is there. And generally, passive funds are low on expense ratio. So I wouldn't invest thinking about too much on the expense ratio. I would think more about what is on offer, how is the selection of the underlying stocks happening, and how does the portfolio fit into my overall mix. Because whatever investments you do will entail some cost or the other. It is the cost of having a wrong investment which can be much higher than the actual cost that you pay for the investment which is being done. So wrong move in terms of having a right portfolio choice is going to hurt you more than the total expense ratios or the expense ratios. Don't worry too much about the expense ratios. They are well regulated, and both passive and smart beta are low, I would say, in terms of expense ratios relative what is being offered in terms of the market returns which are possible. The only caveat is that market can go up and down. There can be risks in the market of a negative return in the near term. And hence, you need to have an asset allocation plan. And all of this, while it sounds easy, it will require an advisor to advise you in general. So have an advisor who can advise on the asset allocation plan, and within that, then you can incorporate the smart beta strategies as well. Don't worry too much about the expense, because whichever investments you do on any kind of platforms or any kind of financial or real asset, there is generally a cost involved, and I wouldn't worry too much about the cost. I'd rather worry about what am I getting in return in terms of the long-term potential returns for that particular investment. Thank you.
Okay. So consider expenses, but take into account the returns and the other factors more, and the asset allocation definitely. Okay. Now tell me, how liquid are these funds to use for any emergency purpose?
Much like any other equity investment that you have, and now with these ETFs having a T+1 settlement, as India has gone into a T+1 settlement, you can liquidate when the markets are on, and the money should ideally come on a working day, the next working day, in line with the exchange settlement. So in terms of liquidity, there is no worry as far as any of these ETFs are concerned. In India, I understand that the number of investors in ETFs are still very small, so the exchange liquidity looks low. But the fact is that we have authorized participants, or in general terms, as they are known as market makers, who are on the market allowing liquidity to be created or creating liquidity for all the ETFs which are there. So investors need not worry about liquidity as such. Yes, I would suggest that for your emergency needs, you normally have a fund which is different from any equity fund. So any emergency requirement which you feel is there could be there. You keep a corpus which is in debt or equity savings or arbitrage rather than having it in equity assets, because equity assets are not meant for emergency funding in general. Still, if you do need the funding and you need to liquidate, then if the markets are on, you can liquidate the assets, and the next day or the next settlement day, in line with the exchange settlement, you will get the funds in your bank account. So I don't see that as a stress. The liquidity is there. The market makers are also there.
All right, so these funds are liquid like the other passive funds, which are traded on the exchange. Lastly, Mr. Haria, we are interested to know whether these ETFs are suitable for our listeners. Please suggest who should invest in the smart beta ETFs for whom it is the right fit.
If we look at equity investing, it's meant for everyone in general with a long-term view. Second, as far as smart beta ETFs are concerned, like I said, it can be low vol, it can be momentum, it can be alpha low vol, it can be value, it can be quality. So you can choose what suits your risk profile. I think from the basic low vol to the other end of the spectrum, which is momentum, in between there is alpha low vol, value, quality. There is something or the other which every investor can choose. And I feel that smart beta ETFs are for all investors, irrespective of how much wealth they have, irrespective of what their age is. All investors can invest in smart beta ETFs because the spectrum of available choices is quite wide, based and which will suit the risk and reward which the investor is looking at from a portfolio construction process. Thank you.
Thank you, Mr. Haria, for joining us today and sharing insights. The contents of the discussion should not be construed as Outlook Money's editorial recommendation. With this, we come to the end of today's episode of Investment Made Easy podcast. Listeners, we hope you enjoyed our conversation today. To dive deeper into investment realms, stay tuned to Outlook Money's podcast series and don't forget to like, share, and subscribe and stay financially informed. You can also share your suggestions, feedback, and questions at letters@outlookmoney.com. Stay tuned for our next edition. Until then, stay informed and keep following Outlook Money, your favorite personal finance magazine.